When you look at a company's finances, how much trust can you really place in those numbers? How do we uh, peek behind that corporate curtain? Transparency is key, right? But what actually ensures it? Today, we're doing a deep dive into a document that sounds, well, maybe a bit formal, the management representation letter. But trust me, this letter packs a serious punch in the audit world.
It really does. And our mission today is simple. Break this thing down. We want to make it crystal clear what it is, why it's absolutely non-negotiable for auditors, what goes in it, and who signs it. Think of it as management's formal promise, a cornerstone of financial trustworthiness, and we'll make sure it's all explained very, very clearly.
Okay, management representation letter. Sounds official. So what is it exactly? Who actually writes this thing? Is it the company saying we're good, or is it the auditor asking?
That's a great question. It's a formal written statement, yes, but it's obtained by the independent auditor from the client management. And here's the interesting part. The auditor usually prepares the draft text. Yeah. Then the client puts it on their own company letterhead, and their leadership signs it. So it's management formally acknowledging their responsibilities and, crucially, confirming representations they've already made during the audit.
Okay, so if they've already said these things during the audit, why the need for this formal letter at the very end? Seems a bit redundant, maybe.
Not at all, actually. It serves three really critical purposes, and we can walk through each one to make it super clear. First, confirmation. Like you said, management has given information all along, sometimes verbally, sometimes implicitly. This letter makes it explicit, puts it down in black or white, no ambiguity.
Got it. Formal confirmation. What's second?
Second is documentation. Things can change quickly in business, right? This letter documents that management's confirmations are still appropriate right up to the very date the auditor issues their report. It covers that entire period.
Ah, okay. So locks in their stance up to the last minute.
Exactly. And third, and maybe the most practical reason, is to reduce misunderstanding. Having it all clearly written out and signed helps prevent any he said, she said issues later about what was represented. Clarity is paramount.
It makes a lot of sense.
Yeah.
It's definitely not just a formality then. It sounds foundational. So, given how important this is, what are the absolute must-haves? What makes this letter valid? And the big question, what happens if a company just says, nope, not signed?
Right. And this is where you see its real teeth. It's absolutely mandatory. It's considered a final essential piece of audit evidence. Auditors get it right at the end of their fieldwork, literally just before they finalize their report. And it covers the whole period they audited, even if, say, the current CEO wasn't there the whole time.
Well, okay, mandatory.
Yes. And here's the critical bit. The auditor must receive this signed letter to issue what's called an unmodified opinion. That's the clean bill of health, the report saying the financials are fairly presented.
And if they don't get it?
It's a huge red flag. If management refuses to sign, the auditor generally has only two paths, and both are bad news for the company. Path 1. Issue a disclaimer of opinion. That means the auditor saying, we couldn't get enough evidence to form an opinion. That signals major problems to investors and regulators.
Oof, okay.
Path 2, withdraw from the engagement altogether. Just walk away, which also sends a terrible signal to the market. It basically screams, we don't trust this management or these numbers.
So the consequences are severe. What about the logistics, the signing and dating?
Good point. The details matter. The letter must be dated the exact same date as the auditor's report. Not before, not after, the same day. And it's signed by the top brass, usually the CEO and CFO, the people with ultimate responsibility for the company's finances and operations. Sometimes other relevant managers might sign too.
Okay. CEO and CFO.
Oh.
On the same date as the report.
Correct. Now, there's a tiny bit of flexibility. If, for some practical reason, they can't physically sign on that exact day, oral confirmation might bridge the gap temporarily. But the auditor absolutely cannot release their final audit report until they have that physically signed letter in hand. No signed letter, no report release. Period.
Got it. Signed letter is the final gatekeeper.
Precisely. And one more key point on requirements. Materiality. You know, the concept of what's big enough to matter to a user of the financial statements. Generally, the representations in the letter can be limited to items that management and the auditor agree are material. Focus on the significant stuff.
Okay.
However, and this is a crucial distinction, this materiality limit doesn't apply to certain fundamental representations. Things like confirming that all board meeting minutes have been provided or that all financial records were made available.
So some things are required regardless of the dollar amount.
Exactly, because those speak to management's cooperation and the completeness of the information provided overall, which is fundamental. And related to that, if the auditor develops serious doubts about management's competence or their integrity,
Hmm.
or if the representations conflict with other evidence.
What then?
If the doubt about management's integrity is significant enough, the auditor again has to consider disclaiming an opinion or just withdrawing. You can't rely on representations from management you don't trust.
That's a powerful check and balance.
Yeah.
Okay, so the requirements are strict, the consequences are dire. Let's get into the specifics. What exactly are the CEO and CFO putting their signatures to? Can't be a one-liner, right?
Oh, definitely not. It's quite detailed. Think of it as a series of specific promises or assertions covering key areas. First up, the financial statements themselves. Management formally states they are responsible for ensuring the financials are presented fairly according to the rules like U.S. GAAP here in the States, the generally accepted accounting principles. And they also confirm they're responsible for the company's internal controls, the systems designed to prevent or catch major errors or fraud.
Okay, responsibility for the statements and the controls. What else?
Then there's completeness of information. This is huge. They state that they've given the auditor everything relevant, all information, all access they agreed to provide, and critically, that all transactions have been recorded and reflected in the financials. No hidden side deals, no off-book stuff.
Super important, covers the bases.
Absolutely. Next is a really sensitive one, fraud. Management acknowledges their job is to design controls to prevent and detect fraud. They have to tell the auditor about their own assessment of fraud risks within the company. And here's the kicker. They must disclose any known fraud or even suspected fraud that involves management, employees with key control roles, or anyone else if it could materially impact the financials.
Wow, suspected fraud too.
Yes, and it goes further. They also have to disclose any allegations of fraud or suspected fraud that have been communicated to them maybe by employees, whistleblowers, analysts, regulators, anyone. It's a very broad net cast to uncover potential wrongdoing.
That is comprehensive. Okay, what else are they signing off on?
Several other key things. Laws and regulations that confirm they've disclosed any known non-compliance that might need to be considered in the financials. Also, uncorrected misstatements. Auditors often find small errors that aren't corrected. Management has to state that they believe these errors, individually and altogether, are immaterial, not significant enough to mislead someone reading the statements. And a list of these is usually attached right to the letter.
Transparency even on the small stuff they didn't fix.
Exactly. Then you have litigation and claims. They need to confirm they've disclosed all known actual or even possible lawsuits and claims. For estimates, things like allowances for bad debts or warranty costs, management confirms their methods, assumptions, and the data they used are reasonable and appropriate.
Right, because estimates involve judgment.
Precisely. Also, related party transactions. They have to disclose all the companies or individuals they're related to and all the transactions between them and confirm they've been accounted for correctly. No hidden sweetheart deals. And finally, subsequent events. Anything significant that happened after the balance sheet date but before the audit report is issued that needs adjustment or disclosure, they confirm that's all been handled properly.
Okay.
And, auditors can always ask for additional representations on specific things relevant to that company, maybe about inventory valuation or asset impairments, or if they plan to sell off part of the business. It's tailored.
It sounds incredibly thorough, almost like a legal deposition in some ways. The sheer scope is impressive.
Yeah.
So we've covered the general principles. Are there situations where this letter needs to get even more specific, like unique industries or audit types?
Yes, absolutely. The core letter is always there, but certain engagements demand extra layers of representation because of specific regulations or risks. Two common examples are audits of employee benefit plans under ERISA and integrated audits.
Okay, let's take ERISA first. Employee retirement plans. What extra promises do they need there?
Right. For an ERISA plan audit, management needs to make some very specific confirmations related to the plan itself. They have to state they've provided the auditor with the latest plan document and all its amendments. That seems basic, but it's crucial. They also explicitly acknowledge their responsibility for administering the plan correctly, making sure transactions follow the plan's rules, and keeping proper records for participants' benefits.
So confirming they're running the plan by the book.
Exactly. And there's a specific type of ERISA audit called a limited scope audit or a ERISA Section 103 AC audit. If management chooses this route,
Mm-hmm.
they have to make even more specific representations. They must confirm they're allowed to use this limited scope audit under Department of Labor rules, that the investment information comes from a qualified institution like a bank or insurer, that it's properly certified, and that it's presented correctly in the financials. It adds extra assurance for this specific audit type.
Got it. Very specialized. What about the other case you mentioned, integrated audits?
Right, integrated audits. This is when the auditor audits both the financial statements and the company's internal control over financial reporting, or ICFR, common for public companies in the U.S. Here, management's representations about internal controls get much more detailed in the letter.
Makes sense, since controls are also being audited.
Precisely. Management must acknowledge their responsibility for designing, implementing, and, crucially, maintaining effective internal control over financial reporting. They also have to state that they themselves have evaluated the effectiveness of their controls as of a specific date.
You have to do their own assessment first.
Yes, and they state their conclusion, their assertion about whether controls are effective and what framework they use, like the COSO framework, for example. And they explicitly state they did not rely on the auditor's testing when forming their own conclusion. They have to own their assessment.
Interesting distinction.
Very. They also must confirm they've disclosed all significant deficiencies and material weaknesses in internal control to the auditor, including any from prior years that haven't been fixed yet. They describe any fraud found that resulted in a material misstatement or any fraud involving senior management or key control employees, and they state whether any significant changes were made to internal controls after the as of date of their assessment, but before the auditor's report date.
Okay, so a deep dive into their control environment.
Exactly. And just like with the main representations, if the auditor can't get these specific internal control representations in an integrated audit, it's considered a scope limitation.
Right.
Meaning they likely have to withdraw from the engagement or issue a disclaimer of opinion on the effectiveness of internal controls. Again, serious consequences.
Wow, okay, so putting this all together, from the basic financial statement confirmations to detailed fraud disclosures, ERISA plans, internal controls, this management representation letter is clearly way more than just bureaucratic paperwork. It really feels like management's formal, signed oath of transparency and accountability directly to the auditors and, indirectly to all of us who rely on those audited financials.
That's a perfect way to put it. It truly highlights the bedrock of trust, or sometimes the lack of it, in that auditor-client relationship. It's that final, critical checkpoint where management puts their name on the line, confirming everything they've provided and asserted throughout the audit.
So for you listening, maybe the next time you glance at an audit report, you can picture this powerful, though unseen document standing right behind it, the management representation letter. It's really a testament to the layers of checks and balances designed to build confidence in our financial reporting system, making sure, hopefully, that what you see is what the company truly is. What part of this whole process stands out most to you? Does knowing about this letter and how mandatory it is give you a bit more confidence? Definitely something to think about until our next deep dive.